Coming up today, stocks finish lower. A look at valuations. Trump and Putin meet up. Are semiconductors in trouble? Retail sales come in strong. Consumer sentiment comes in weak. Jay Powell's last stand. And the bubble that nobody is talking about. It's been another great week, guys. Let's go. And welcome back, everybody, to the Daily Market Review. And if this is your first time to the channel, welcome. My name's Jared. I make these videos every day after market close, breaking down all the biggest news, events, and data that we've got from across financial markets today. So if you're an active stock trader or investor, make sure you smash that like and subscribe button, and these videos will show up in your feed every day after market close. And so we're going to cover a few things in today's show. We're going to look at stock market valuations, the NASDAQ. We're going to look at what's happening with Trump and Putin in Alaska. And we're also going to talk about the US housing market, which is a similar story in all developed markets. Are home prices in a bubble, and could they potentially pop? And I'll show you a bit of data to do with the real estate markets. So if you own a home or you're thinking about buying a home in the future, make sure you stay tuned into this video, and I'll give you the bird's eye view of the real estate market as well. Just looking at the price action we got here today, finishing the week out. Once again, just as we've been seeing all week, mixed breadth, getting some sectors like healthcare continuing to pop today after we got news yesterday of a bunch of super investors piling into United Health. Warren Buffett, David Tepper, Michael Burry, the list goes on. But overall, we saw some weakness in industrials, semiconductors after applied material delivered a disappointing earnings result, along with the potential threat of tariffs. I'll show you how they're looking like on the charts, and financials pulling back a little here today as well. And I'll show you some data why the market could also be vulnerable to a bit of a pullback, or at least some softness and consolidation for the rest of this month. We do have some bearish divergences building on the charts as well with my indicators, and I'll give you a rundown of all the major markets, so you've got a good idea where everything stands going into next week, along with what to pay attention to next week as well. A certain sector is going to be in play. But first off, just looking at the NASDAQ, along with the mega cap tech stocks, have really led this rally the last couple of months. And no doubt, on a lot of historical measures are very stretched when it comes to valuations now, with the NASDAQ market cap reaching a record 145% of the US M2 money supply. That's basically the amount of money, liquidity in the US economy. And that's actually greater than what we saw back in 2000. And so no doubt stats like this have got a lot of people scratching their head about how much further this can go, and whether, just like real estate, are tech stocks in a massive bubble right now. Because on many measures, they are reaching records. Got a great chart out from Fidelity today, showing the market weight of the top 50 stocks and the top 10 stocks down in the bottom here in the orange and the blue. And so we're currently in the era known as the Magnificent Seven, the mega cap tech stocks, who are 7 of the top 10, and they're now 35% of the market, which over the last 100 years we've only seen exceeded a little bit back in the roaring 20s. A lot of industrial stocks were doing well back then, but the weight of the top 50 stocks was even greater back in the 20s than it is today. But we've already surpassed the tech bubble in the concentration of the top 50 stocks. Up the top of the chart is the S&P's 500 10-year compounded average growth rate here in the purple, which is currently around 13. So the market been growing on average 13% a year for the last 10 years. Pretty good, a bit above average, but still not near those crazy peaks we saw in the late 90s or back in the bull market of the 1950s. What is near the peak, though, is the 5-year cyclically adjusted price to earnings ratio here at 32. We only ever went a little bit above that back in the late 90s at 35. And of course, there's big fundamental drivers of this bull market. AI could very well be the biggest secular trend and bull market of many of our lifetimes. Massive explosion in CapEx ever since ChatGPT was released in late 2022. And the forecasts is that set to explode for the rest of the decade. In fact, analysts estimate just Meta, Microsoft, Amazon, and Alphabet's capital expenditure will surpass $500 billion come 2029. And we've got this huge force in the market, as you're probably one of them yourself, an active retail trader. And especially over the last couple of months, the amount of volume us retail traders have been doing has been steadily increasing, and we now represent around 15% of all total stock market volume. And I think this has the potential to climb a lot higher over the coming years, as all brokers are experiencing strong growth, as it's just so easy to get into the stock market these days, and more products coming onto the scene as well, along with crypto being integrated into the New York stock exchanges via ETFs, crypto miners, and crypto treasury companies. As the government's legitimized this industry, a lot of capital's coming to it, and us retail traders are a big driver of that. So no doubt the NASDAQ and S&P are not cheap on a long-term historical basis, but it's important we put that into context, because just as that data from Fidelity showed, we do have very high levels of concentration in the indices, meaning just a handful of stocks is skewing the stats. And so the S&P 500's forward PE is up there at 23 times earning. Keep in mind, corporate margins are also at all-time highs. and corporate profit growth is still tracking on a healthy double-digit pace. But what we've also got going on is a huge gap between the valuations with the rest of the market. The equal weight S&P valued at 17 times forward earning, which is not all that bad in a 3.7% interest rate environment with double-digit EPS growth. And it's kind of a similar setup to the late 90s and 2000. Small and mid caps were way cheaper than large caps, and they significantly outperformed for the next 10 years actually. And the growth with the rest of the market is forecast to significantly narrow with the Mag 7's growth. In their EPS, they really excelled in 23 and 24 with their earnings growth, but the rest of the market is catching up into next year. Some estimates show the rest of the market could be growing on par with the Mag 7. And if that's the case, there should be a good chance that the relative value of small caps to large caps catches up going into next year, as it looks like it's been technically forming a base for a few months here. I still like small caps. I think it's worthwhile having a decent allocation in an overall portfolio to them, as I think plenty of investors out there may be too leveraged to mega cap tech without even knowing it, because they may hold the S&P and NASDAQ indices along with some tech stocks as well, and 70-80% of their portfolio is completely leveraged to mega cap tech, which, like any part of the market, can have a massive correction on its own, while other parts of the market can actually hold up or even continue to grow. So on S&P and NASDAQ valuations, for sure, things don't look so cheap, but expensive can get more expensive. Things can go on a lot further than what we realize. Previous records can be broken, and just stepping back and looking at the big picture. And this chart is 2 months old, so the market has gone up another 6 or so percent in that time, but still pretty much the same picture here. And what you'll notice is that relatively this bull market is not all that big yet compared to prior bull market we've seen. So for sure, there could be plenty of room to go, especially if small caps can catch up, and maybe at some point we see mega cap tech maybe not crash but consolidate for 6 months, 12 months, 18 months. But at the end of the day, bear markets are just little blips on the map here, significantly overweighed by the bull market. And looking at this chart, it just goes to show that if you do have dry powder, buying in bear markets is always ideal if you can tolerate the volatility as well. And some are saying we're even in a new bull market after the Liberation Day correction, which did technically cause a bear market using the long-held definition of a 20% pullback. That's what the S&P 500 did into early April. But for the here and now, like I was saying earlier, in addition to some decent bearish divergences going on in the charts, we are coming into a seasonally weak period we can normally see in the market, and a lot of that has to do with corporate buyback. And we saw a massive peak in buybacks in late April, early May. That likely helped the market push up, give a big V-shaped recovery. And whilst overall this year we're on track for 1.1 trillion, over the next couple of months, we go into a seasonal buyback dry zone. And what you'll notice in history, there's strong correlation between short-term market returns and the amount of buybacks. That is, companies buying back their own shares with cash, which helps to squeeze the stock price higher. So I think that, along with the fact the VIX has just been grinding here for months and months, I'd be surprised if it just went on like this all the way through to Christmas without some sort of little surprise or bump up, or even just profit taking and a technically induced sell-off. So if you made some pretty good gains on your portfolio so far this year, one way to lock it in without selling is just to buy a little insurance. You could buy VIX calls, turn it into a call spread, buy the 14 strike, sell a 24 strike, or you could just simply buy puts on the SPY expiring in December or maybe January next year, as volatility is at yearly lows but probably won't stay there. And that can make for a good time to add some hedges if you're into that kind of thing. Now just moving on to another topic that's not really discussed a lot, and that's whether housing markets, not just in America but also Canada, the UK, Australia, New Zealand, Western developed market, in which home prices have been inflated for years now, gone up a lot more than the growth in people's incomes. And that's thanks to a huge secular trend of lower interest rate, which pretty much kicked off in the late 80s, talking about a massive 35-year trend of interest rates peaking out, again, across developed markets, around 15, 17, even 20% mortgages in the late 80s. And that, along with pro-legislation to incentivize property investing and a lot of people turning it into a hobby, helped to take home prices to record levels across the developed world. The median house price about 3.5 times the median income in the mid-80s. That's gone up significantly to more than 5 times. And in many cities, it's even greater than that, 7, 8, even 9 times income. And so just like tech stocks, real estate, residential homes in developed countries are at record valuation, and they have been for a few years. We have seen some pullbacks in some markets, but also plenty of consolidation. We haven't really seen a crash yet. And so could that still potentially happen, like we saw in America after the GFC? Because we're getting some similar stats to back then as well. We got the highest inventory of US new single-family homes for sale since October 2007. And just like a lot of countries, it's definitely a buyer's market. Looking at data from June, there are over 500,000 more more US home sellers than US home buyers. You can see what a stark contrast that was to back in the pandemic. We saw an explosion of people wanting to get into the market. As we were forced to stay at home, a lot of us adopted the work from home culture. Not many people wanted to move or sell, and so it just caused a huge squeeze on prices, in addition to the massive liquidity injection from the Fed and the government printing and spending, which of course created a lot of inflation. Interest rates had to go up, and that's what always cools the real estate market when rates go up. And so it's kind of been in a bit of a holding pattern because most American homeowners have been locked into low rate mortgages. But wouldn't it be a funny thing if rates come down and that's what causes real estate to pull back, because that lowers the bar then for people to move, which adds even more inventory onto the market. And again, just looking at another measure for real estate valuations is the mortgage payment to income ratio, also hovering near all-time highs, which is actually at a similar level to back in 2006 before the real estate bubble popped. And so over the last couple of years, it's been a lot better to rent than own. But just like we saw back in the GFC, markets can correct, and they can correct quickly. Most always eventually mean reverting back to the average, which if it did, I think would catch a lot of people by surprise because it's not really something that's been talked about. I remember back in 2007, it was well known the real estate market was in trouble. There was issues with subprime mortgages. Hedge funds were already starting to blow up. Market didn't really crater into Q3 2008 and finally bottomed late Q1 09. Kind of took a while to actually play out. And just like back then, we're getting some crazy stats today. Like according to Fortune, last year, there were more home buyers over the age of 70 than those under the age of 35 in the US. And so I think a lot of millennials, most of whom still rent, would actually welcome a crash in the real estate market. Of course, to the dismay of boomers, especially those that own 10, 20 houses and rent them to millennials, because we've seen a dramatic decline in the estimated percent of 30-year-olds who are both married and homeowners. 1950, over half of 30-year-olds were married and owning a home. Today, it's about 12%. It looks like it's on a path towards 0%. And so in my opinion, the only way that millennials can really get onto the property ladder is if we do see a big correction in the market. And if so, some REITs may be vulnerable to a correction, like American Homes for Rent, Equity Residential, Avalon Bay Communities, and Invitation Homes, another REIT that own residential houses. And so I'm interested to hear your thoughts. What do you think about all that? Do you think developed housing markets are in a bubble? Do you think they're vulnerable to crash? And what do you think could cause that? Moving on to Trump and Putin, who just met up in Alaska. Trump in a show of force, full of B-2 stealth bomber and some fighter jets right over his head, which I think may have caught him a little bit by surprise. And those talks have just finished as I speak. Appears we didn't get a deal. Trump said the talks were very productive. And as we were saying, we're likely to get some progress here and maybe set the groundwork for a ceasefire. Did get some brief remarks from Putin. He said he expected Ukraine and its European allies to accept the results of the US-Russia negotiation, warning them not to torpedo the progress towards a resolution. So highly likely Putin's got some big demands, probably wants a chunk of Ukraine and to appear like the clear winner to accept the deal, whereas I think Trump just wants it done kind of either way. But of course, it's a delicate issue when shifting the borders on the map. It's always going to be controversial, but at this stage, it should hopefully be a positive step towards ending the war. And just looking at how markets are trading after hours as I speak, oil's just come off a bit, along with gold flat, so there's no big reaction to what's happened in Alaska. Looks like to be a non-event for markets here. But what could be something for the market is if semiconductors get slapped with 300% tariffs, with Trump putting the squeeze on companies to build chips in America. That's the whole point. Helping to persuade not only big American companies like Apple, but even foreign companies, shift your supply chain to America. And so that caused a bit of weakness in semiconductor shares today, along with Applied Materials, issuing light guidance on their earnings and citing weakness and uncertainty with their China business. And there's a look at AMAT today, down 14%, pretty heavy move, helping to make semiconductors the weakest sector today, down 2%, with the largest Nvidia still grinding. Really low volatility here, as we can see on the vol heat map, has not uncoiled for quite some time. And speaking of China, they're not exactly welcoming Nvidia back with open arms. They've actually issued an order to their own companies to try and deleverage themselves from American tech, even though they still very much need it now. And likely for years to come, they don't want to build their whole future on top of American tech, just as they're still getting softness in their own economy. Industrial output, retail sales coming in lower than expected. And there's an interesting correlation between China's PPI, their producer prices, and America's CPI, consumer prices, with China still being the world's manufacturer. If they're experiencing deflation, it's very hard for the rest of the world to get too crazy on inflation with our consumer prices, because so much of our stuff comes from China. And so you can see over the years, there's a strong correlation between China's PPI and America's CPI. And China's PPI has been coming down, whilst we've only seen a small uptick of late in America's CPI. But a lot of consumers are still worried about inflation. There's still a lot of uncertainty about whether we will see a big jump in inflation from tariffs. Nobody has experienced this level of tariffs in their adult lifetimes. You'd have to go back to the 1930s. And we did just get a hot PPI print yesterday. In fact, it was an 8 standard deviation move, which in theory is only supposed to happen every 6 billion years, but we just so happened to get one 4 years ago as well. It was even bigger. That's the thing with financial markets. They give us fat tails that you don't normally see in a normal bell curve distribution of data, say people's heights, for example. So this last PPI we got could very well be an anomaly, an outlier of a print, because what we do know for sure is consumer spending isn't slowing down. In fact, it just came in with a beat. So a bit of mixed economic data this week. Retail sales notched another strong month, rising 0.5% in July from June, suggesting American household spending remains resilient. And in fact, we've even seen signs of a splurge of spending with jewelry, which is a super discretionary item, not a necessity at all. And we just heard from Pandora CEO, they just posted an 8% rise in US sales. Same with the owner of Cartier, posted a 17% jump in America's sales, showing that the wealthy consumer is still out there and spending, and they're a big driver of the economy. And as all this unfolds, we're still learning about tariffs and how they're playing into the economy, because high tariffs haven't caused inflation to surge as much as this article says some, I would say most, economists expected. And that's because there's a few things going on. More than half of US imports were duty-free. And the weighted average tariff rate, that is the average of all tariffs, adjusted for import volume from each country, was only 9% in May. Even though there's been plenty of estimates that it should be 12%, I've even seen 15%, some say 17% is going to be the global average tariff rate. So the effective tariff rate has been much more modest than commonly thought. And companies are already rejigging their supply chain, as markets are great at doing, adapting, finding the cheapest path to get goods to consumers, while the government tries to weave the needle, exempting some products, threatening higher tariffs on others, whilst trying to keep a lid on inflation. And it is actually encouraging investment into the US, with more factories planned to be built there. But consumer sentiment is still weak, still a divergence in the soft data and how people are feeling, and the hard data, the actual spending that we're seeing. University of Michigan Consumer Sentiment Survey dropped to 58.6, down from 61.7 in July, with consumers still concerned about inflation and unemployment over the next 12 months. Moving on today, we saw a huge rip in solar stocks as Trump's tax credit guidance is less stringent than feared. Residential solar systems will continue to qualify under prior guidance, and the new rules will not be applied retroactively. And larger projects must meet a physical construction standard, but will still have 4 years to complete their development. And so these solar stocks, which have been kind of beaten around the last few months on this pending legislation and what exactly Trump's going to do with the clean energy and the tax credits, they got slammed down in Q1 coming into it, but every single dip you can see quite easily here on the chart was just bought up big time. Another big rip there today. First Solar 11%, Sunrun 32%, and a few others as well. Enphase Energy up 8%, and that still looks like it has some work to do to catch up to the rest of the sector. Big event next week will be Jackson Hole. Get to hear Jay Powell. Barron's could be right, could be his last stand, and his legacy and the Fed's independence are on the line at Jackson Hole. I think either way, whatever he does, it's going to look political. If he cuts, a lot of people just say he cut because of pressure from the president. If he doesn't, many others will say he's not cutting because of the president. That's why I think he should step aside and give the Fed a clean slate to start with, as he's in a much different environment to what he was just last year. So it'll be interesting to hear his take and whether he is still sticking to his hard line of being hawkish and forecasting tariffs to increase inflation, or whether he'll bring rates in line with the market and close the monster gap we've got going on between where the Fed's at and where inflation and bond yields are at. Because even after that strong PPI print yesterday, got a little bump up in bond yields, but didn't send them screaming higher in a monster green candle, meaning the bond market is not really fearing inflation here. Moving on with a few other things before I show you what's moving out there on the charts today. Tom Lee's Granny Shots ETF just did a rebalance, removing 5 names and adding 6 names. And there's a look at his portfolio, heavily leaning in tech, but also diversified with some financials and even some industrials, and of course a big focus on AI. And so far so good. He is outperforming the market since launching his fund in November last year. Doing a pretty good job here, but doing slightly better since launching his ETF. Dan Ives of Wedbush, another big time tech bull, slightly outperforming Tom Lee since he launched his ETF back in early June. It was OPEX today. Once again, as of late, they've been quite uneventful, even though it was a record in notional open interest. Almost 3 trillion of options expired today, as usual dominated by the most liquid options out there, the S&P 500 index options. coming in at 1.1 trillion, SPY options, a quarter of a trillion, and over 700 billion in stock options expired today. A monster OPEX, and next week the focus will be on retail stocks. Got a number of key names reporting, starting off with Home Depot before market opens on Tuesday. Then we get to hear from Target, Estee Lauder, TJX on Wednesday, before finishing out with the big one, Walmart, on Thursday, as we move towards the end of Q2 earnings season. And it's getting back to the charts. We got some mixed movements, just like in large caps and hot growth stocks. Robotics pulling back a bit today, along with a bit more softness in nuclear stocks. Same with battery stocks, and space stocks also consolidating this week. The hot quantum sector taking a bit of a pullback today. Nice bounce there for Oscar Health. Like I said yesterday, looked like the dip was being bought and was being accumulated. Still looks good to me here on the chart. Nice bounce for Moderna after my reversal signals. Nailed the low on that. Little pullback for Palantir. Still not that far off all-time highs though. Drone stocks taking a bit of a breather, along with crypto today as well. Had a massive run up in Ethereum the last couple of weeks. Not too surprising to see a little bit of a pullback, but I am keeping an eye on these Ethereum treasury companies for some dip buys next week. SharpLink Gaming currently trading under NAV with its ETH holding. I'll be watching that one next week. Same with the ETH machine, taking over 180 Life Sciences and Circle as well. Still got plenty of fintech holding up well. There's Tiger Brokers, not too far off highs, and Rare Earth Materials holding up pretty good. And we're still getting plenty of new names, attracting a lot of retail attention, like Wheels Up Experience, an airline company, ticker symbol UP, shooting up there today, and retail favorite Open Door Tech also having another good day. Otherwise, just looking at the main indices, still a little soft to finish this week. But just going out to a weekly chart, still looking quite constructive here on the Russell 2000. We did make high highs, high lows, and even on the S&P 500 as well. Appears to be pushing up here, still grinding, along with the Nasdaq. Definitely stretched here in this entire move off the April low. We'll eventually get that big red candle, especially the further and higher this goes on for, but that is if it doesn't move into a melt up mode. But we do have that seasonal weakness, that corporate buyback dry period, and we've kind of just finished Q2 earnings season, which I guess did come in pretty good. But like we can see in my sector breadth table indicator, it's just pretty mixed, even within sectors as well. Plenty of stocks going up, plenty going down. It's actually a great time to be a technical trader. A lot of technical patterns playing out beautifully of late, actually. Me and my options members had a great week. And if you're interested in learning more about my premium trading services, click the link below this video and you can trade alongside me every day and get all my custom tools. Otherwise, that's pretty much a wrap for the daily market review this week, guys. Thanks for watching and supporting this channel. Have yourself a relaxing weekend, and I'll see you back here again at Click Capital come Monday night. Cheers.